Chapter 4 talks about long-term planning and budgeting. It's basically about how does a company do its budget every year and what is affected by it. So basically we assume that sales are whatever they were in the previous year, and then we adjust them by some percentage. That percentage could be down if you thought your sales were going down. Typically in our problems they're going to be going up. And then other categories like costs, other costs, are going either to move with sales or they're not going to move with sales, and it'll allow us to come up with both an income statement and a balance sheet, and that will give us an idea of where everything's going to stand next year should our sales move in the direction we think they're going to move. We can also move costs explicitly. For instance, if our company was involved or had costs that were petroleum. We had a lot of, I don't know, delivery vehicles or something, so we had a lot of gas, and we thought gas prices were going up and down. You could adjust your costs to deal with that. We don't deal with that individually in here. We just assume that the variables either move with sales or they don't move with sales, with a couple of exceptions. So this is an income statement that I just made up for a company, and I'm assuming that we're going to now predict what our next period's income statement and balance sheet is going to be based on a rise in sales. And we'll say we're going to have a 25% rise in our sales, and then you'll be told the categories which move with sales and which don't. I guess I should make this a little bit lower. 25% rise. And for instance, usually costs and other costs are going to move with sales. So they're also rising by 25%. In this case, we'll say interest paid remains unchanged. That is, the amount is going to be the same from one period to the next period. Oftentimes you'll see the tax rate also remains unchanged. That's different from the tax amount remaining unchanged. It means 25% that was used in this year is also going to be used next year. So whatever we get for earnings before taxes, we'll use the same 25% rate. And we'll also assume that the dividend payout rate remains the same. We'll assume that the dividend payout rate, we'll say it's 70%. So whatever our net income is, multiply that by 0.7, and we'll get what we paid out in dividends. That would be $97,125, and whatever's left, 30%, or do the subtraction, you'll get your additions to retained earnings of $41,625. Now, if you weren't given your specifically given your dividend payout rate, but you were given this income statement and say, okay, sales are rising by 25%, and the dividend payout rate is going to remain the same, but it's not written anywhere that the dividend payout rate was 70%, you're going to have to calculate what that rate is. You're just going to take 97,125 and divide it by 138,750, and you'd get, oh, they paid out 70% in dividends last year. I'm going to assume they're going to pay out 70% next year. One other note, when I calculate percent change, so in this case we've got a 650,000 for sales. They're rising by 25%, so we're going to have 162,500 in additional sales next year. Add that to our original amount of 650, and our new sales will be 812,500. I use a shortcut where I just multiply by 1 plus my percent change. So in this case, 650 times 1.25 will give me the 812,500. And that always works, and you'll see me use that shortcut almost all the time. I just multiply by 1 plus the percentage change. If you had a 10% rise, it would be 1.1. If you had a 5% decline, you'd multiply by 0.95. Okay, so let's start working through our income statement. We already did our sales. They increased by 1.25 to give us 812,500. Costs also moving with sales, increasing by 1.25 to give us 437,500. Other costs also moving by 1.25 to give us 112,500. This is probably depreciation, and the book doesn't go into how you would calculate depreciation because it would be a little bit more complicated than this method. So we'll just call depreciation other costs and assume that they move with sales. 262,500 is our new EBIT. Interest paid remaining unchanged, so we'll do the same. 25,000. We didn't take on any additional debt, so that's going to be the same, giving us 237,500. Now we're multiplying that 237,500 by the tax rate, 25%, to get us to 59,375 in taxes paid. Net income will now be 178,125. Multiply by our dividend payout rate, 70% here, to get 124,688 in dividends, additions to retained earnings, 53,437. This 53,437 is really the only reason I believe we're doing an income statement here. This number we're going to have to take over to the balance sheet and put it into the additions to retained earnings. And that's what we'll continue with. We'll continue with a balance sheet on the budgeting process.